Thank you to everybody who's here. My name is Michael Weiser. I'll be moderating this panel. I'm president of GFI Realty Services. We are a full-service real estate brokerage, investment sales, debt, and equity based in downtown Manhattan. Our focus used to be New York City, and with the rest of you investors in this room, we kind of migrated to this other market called out of state, which includes so many incredible places. So we do a lot of all that. And we've got a full team of people here today, and if you're not doing business with us, you should. And I'm here to hopefully get this panel sharing some insightful information that can be beneficial for everybody. With that, I'll allow each panelist to introduce himself. Will, if you want to start.
Good afternoon. My name is William Yagoda. I work for Twin Oaks Equity Partners. We've been in business since 2009. I don't usually do panels, but my friend Jason asked me to do it, so I'm here with him. My background is in real estate. I started back in 2004. I was the first MBA ever hired by Joe Shatreat. I worked with Joe for a number of years, worked at a real estate fund after that, and then started Twin Oaks in 2009. We started doing debt, which is relevant again today, I guess. We went into building buying back in 2011, bought some Uptown, bought some Brooklyn, left New York in 2016 because it felt pricey. We went to North Carolina, which I'd actually done a fair amount of business for Joe down there back in the day, buying commercial buildings. I don't understand out-of-state multi, but Jason can help me. And came back to New York in 21 because I felt like people got freaked out by COVID. So bought 8 buildings in New York back in 21. Went to Israel for 10 months between August and June of like a month ago because Jerome Powell started talking and it felt like it was not going to be an opportunity to buy or sell anything. And now I'm back and I'm ready to buy some more. Nice to meet you.
Jason Wisotsky. First of all, I just want to give a shout out to the whole Rebeach team and the Real Deal chat for really putting together a phenomenal event over here in a pretty short time. So give credit where credit is due. Jason Wisotsky, Four Corners Development Group. I started my firm in 2012, exclusively focused on New York City investment, development, and management. We only owned and bought in New York City until 2019. 2019, when the rent laws changed and we were very active in rent-regulated, rent-stabilized buildings at the time, we then shifted. That essentially put a dagger in our operation. We'll talk about that a little bit in a few minutes. We shifted to out of state, out of New York real estate. We now own in 4 different states, looking to increase our portfolio. Haven't bought anything in New York since 2018. I remember when Will did that deal in 2021. I thought he was crazy, but I think he did very, very well with it. And now we're exploring getting back into New York City.
Hi, I'm Elliot, Horowitz, Equities. We are a debt and equity investor. We own apartment buildings in New York, New Jersey, Atlanta, North Carolina, and Philadelphia. And we have medical office properties only in New Jersey at the moment. And then we make senior loans, mezzanine loans, and preferred equity pretty much on every asset class except for, except for hotels. We're a GP in some investments, many investments. We're an LP in some investments. And we're a debt investor in other investments. So we have sort of a broad perspective, hopefully on the panel today, which will fit the objectives. And we're kind of active this year, looking to get more active, and I anticipate a great conversation today.
Great. Well, thank you, everybody, for introducing yourselves. And I should point out to those of you sitting in the audience, the benefit of being up here, the air conditioning is fantastic.
Phenomenal. It's the best.
There's an open seat if anyone wants to join.
We won't even ask you any questions. Just take the seat. Okay, so our panel today is going to focus really on 2 topics. One topic is New York City, the Big Apple, versus the rest of the United States of America, as we'll call it fondly, the pros and cons. And the second half, we'll talk about GPs and LPs, sort of the do's and don'ts, all the potholes, the issues some people have had. We've gotten some advanced questions, and just try to share. And as Elliot pointed out, our panel here really does sit on probably every part of the capital stack and transaction collectively. So I'm confident and excited that we're going to get some really good dialogue here. So with that, we're sort of going to open with New York City. A lot of people, Jason, as you said, you invested in New York up until 2019, and then you kind of stopped. So why don't you just lead us off with, are you doing New York right now? If you're not, why? If you are, what are you thinking?
Okay, so as I mentioned in the introduction, so we haven't purchased in New York since 2018. The last property we bought was a 55-unit rent-stabilized building in Flatbush. And we have obviously dealt with, which is well documented and well spoken about, and certainly a lot of it is in the news. We've dealt with a lot of challenges, both in regulation, compliance, and really, you know, a very tough tenant base that is getting more entitled and more ruthless in their treatment of management and owners as well. So it's New York City is a big challenge. On the other side, I mean, there's no place like New York. So we've been buying out of state. I think many of you who are active in out of New York real estate, you know, sometimes you get that property in your inbox that's a new construction in a prime location with all the amenities. You know, sometimes the rents are 50% lower than what we're getting in a pre-war building in Flatbush from Section 8 in New York, right? So New York has obviously something that, you know, the rent levels based on who our tenant base is very, very high. And something I think that people should look more into now, because, you know, you're not buying smaller properties or that might be harder to manage or they have to self-manage. In Austin, Texas or Miami, Florida, it's much harder. You know, here in our backyard is an opportunity to buy properties that are really still some of the best real estate in the world. But you do have to be ready to handle the challenges that come along with it, which require a lot of knowledge, education, and really bulletproof nerves to deal with a lot of what's thrown our way. A lot of it is caused obviously by the political environment and all the, I think, the elected miscreants that we have in office, I think I can say that here, who cause us, you know, just an unbelievable amount of, you hear me sighing as I say it, but it makes it a very difficult environment, and you know, it's just something they have to make sure you're ready to deal with and they are very knowledgeable about before you take it on in a significant fashion.
So, Will, you're pro or con New York?
I
Bullish or
mean,
bearish?
I'm always pro New York, right? I think
Let's make it more specific. Rent-stabilized real estate.
So the way I put it, first of all, to Jason's point, when someone starts working for me, the first day they come to my office, I send them to landlord-tenant court for the whole first day. That's their like intro to New
Will
York.
doesn't have too many employees.
They all leave. But that's the intro, right? You gotta just be real about what you're dealing with, and it's not the most comfortable. It's not the way things should work, and that's the game. I have never and probably will never buy a fully rent-stabilized building. But having said that, I think that there's an interesting moment in the market where rent stabilization is just viewed as completely taboo and horrible by people, and for that reason, I think if you can buy a hybrid with free market rents and rent stabilized units, there's a real opportunity out there. You know, we try to target like 60 to 70% free market with the rest of it being rent stabilized, and it's very simple. Like, I make my model, rent stabilized rents go up 1%. Brokers don't like to hear that. They tell me how it went up 3% this year, but I feel like long term, if I can make the numbers work at a 1% growth rate, that kind of makes sense.
So, Elliot, you and I were talking, and you're in multiple parts of the capital stack, debt as well. How do you view rent stabilization within, through those glasses?
So I hate it, right? So, so 6 or 7 years ago, we were fully Brooklyn, only Brooklyn, rent stabilized. We bought a lot, and every month we were buying something else along the way. In about 2016, that stopped not because we knew anything was changing. It stopped because the cap rates got out of control. But when I read in January of 2019 that the list of proposed legislation that was going to be proposed that could maybe pass in June, I said game over, right? Because you read it, and then when it passed in June, it was game over. So it's very hard to take a rent-stabilized building, which was once a great investment. It was conservative. It was smart. You always made money. You treated your tenants right. You did well. They left. You raised the rents, and you did phenomenally well. But once they took away politically, right, they took away every avenue to raise rents, it became impossible. So I am not a fan of the regulation. I love New York. I love it to death. You know, we've made loans in Brooklyn over the last couple of years. We're bidding on something now in Brooklyn to be pref equity on a $50 million worth of property, right? So I'll be in New York at a certain basis, at a certain coupon, with a certain type of sponsor. But for me to buy rent stabilized, I'd have to be stealing it in like the best corner of Brooklyn potentially.
But you're comfortable lending on it.
100%.
And where do you see the distinction?
Because if a building was worth $15 million, let's say, and maybe it would have been worth 20, and now it's worth 7 or 6 or 9, and I'm in there at 5 million and I'm getting paid appropriately, and I'm at a 9 cap basis or a 10 cap basis, wherever my basis is that I'm comfortable for that specific building, I would lend on it.
So in other words, risk adjusted, you're comfortable with the returns.
Risk adjusted, I'm comfortable. I'm not comfortable buying a fully rent stabilized building at a 6 cap with 6% financing, because where am I going to go? What am I going to do with it?
Fair enough. So, what I could say at GFI, what we're seeing, and I'm sure, and many of the buyers and the other brokers in the room as well, if we look back to the early 90s, right, everything traded on a GRM, a multiple of rents, and sort of like, let's call it 2004-ish, 2005, if I'm not exactly sure what moment or what month, we started to hear about this new word called cap rate, right? And New York City stabilized deals never traded on cap rates. And then that migrated to price per unit, because at the end of the day, price per unit was really a function. When you've looked at stabilized deals, it wasn't a question of if rents were going to go up, it was just a question of when. So all those metrics were sort of a valuation of what rent could be, where is it today, and then how did the building price relative to that. Well, as you said, in 2019, sort of that came to a shortstop. But what we're seeing today is cap rates in the Bronx at 8+, real, not brokers' numbers, real numbers, vacancy, real expenses, management fees. Brooklyn, Upper Manhattan, north of 7, some deals slightly below that. And so, granted, we've just had another increase in rates, but if I look at a deal that I could buy, let's call it an 8 cap, and my leverage is, let's just call it, with my constant, is 6.5, just to keep the numbers simple, right? And I'm buying it with 60% leverage, okay? When interest rates drop, and I'm not going to call it if, I'm going to call it when they drop, by a point. I'm not talking about a 2.5 to 3.5% interest rate environment. We're talking about rates coming to 5, 5.25. Right then and there, I've made money. The question is it a 2x? Is it a 1.5? Depending how long it takes. So with that as the backdrop, I'd like to pose the following question to the panel. If I look at New York versus any other market, okay? Any other market in the country, for the most part, you pay tenants to move in. Use locators, you're giving concessions and whatnot. And if they don't pay rent, the eviction process is nothing like New York. Your rents go down candidly in a recession. When we look at major unemployment, take a dart and put it anywhere on the board of the country, the odds are rents are going to go down. Rent stabilized rents, I'll use the word never, but they never go down. So, with the backdrop of where cap rates and interest rates are for New York, yes, there's a regulation, you got to know how to deal with it, and you can't change politics. But do you really feel that, be it the Carolinas or Atlanta, wherever it is, at least for today, is a better place to put your money than rent stabilization? And whoever wants to take it.
I'll take it. We own in North Carolina, and I love it. Absolutely love it, right? And we own in Atlanta, and I absolutely love it. We have New Jersey. I mostly love it, right? So, particularly our commercial, which is doing great, but separate from rent stabilized. For me, personally, it's not worth the agita for me to figure out if in the Bronx, we have 18 buildings in the Bronx, 4 of which nobody pays us rent, right? So, and there's some opportunity there, I think, with certain operators. But for me, from a non-managerial standpoint, from an investor standpoint, we're having successes in other neighborhoods, other cities, other states, where the rents are cheap. We're raising rents to $1,200, not $1,500, not $4,500. I'm not dependent upon 3 young people sharing a 2-bedroom paying me $4,000. So where we've been buying, we've had success in taking very cheap rent and going to also cheap rent. So I like that model better. It's less taxing on the soul. I don't know that I'd want to be adding on to things in the Bronx right now. In Brooklyn, I would add maybe super selectively if we could find something really appropriate. But the regulation is just, I have PTSD from June 2019, and I don't want to add on to it right now.
Fair enough. So it's not really a technical answer, it's more emotional.
To some degree,
Okay.
but it also is technical, because if I can buy a building in North Carolina with $900 rents, and the day I close I'm adding $1,300 tenants, that's money. That's money, real money.
So you're more focused in, let's call it the B- space, is that a fair assessment?
These are B-, B+ properties. B-,
Got
B+.
Okay. Any thoughts?
So regarding your point about any type of decrease in interest rates, I mean, that's obviously going to have an effect on every asset class in every corner of the country. With regard to yes, rent stabilized rents are not going down. But we are facing a challenge now, obviously, when we do get a vacancy, which used to be a blessing in a rent stabilized building. Right, keep in mind, when we're talking about rent stabilized, you buy in other parts of the country, you try and take rents from $1,500 to $1,700 by doing some basic upgrades. When we were taking rent stabilized buildings, we were buying out rent stabilized tenants who were paying $800 to $1,000 and renting out the apartments for $3,000, $4,000, $5,000, right? So we were buying these properties at 3.5 caps in New York City, several years ago. But the upside was, obviously tremendous. So when that got taken away from us and the buildings essentially almost became worthless because they were not worth the amount of their debt, which is a struggle that anyone who's been in the business now for a few years is dealing with. The cap rates obviously have to be strong enough to sustain. If you're talking about an 8 cap, I'm actually looking at some rent stabilized properties again. If the cap rate is really strong, so yes, the rents go down, but there's another phenomenon that we deal in New York. Will talked about landlord-tenant court. So we just evicted a tenant in Colliers County in Florida. It took 3 weeks to evict a tenant who owed us late fees, okay? We have tenants in rent-stabilized buildings that owe us, and I'm not talking about one case, several, $40,000, $50,000, $60,000 on $1,000 apartments that haven't paid rent in years, and sometimes the case just gets couched, and we're waiting for a decision from a judge that, you can switch L&T attorneys several times because you think it's their fault, but it's really not. They're all doing the same thing. The judges, they play their game, and that's something that's not, with all due respect to the brokers and
fair.
That's not
I
something.
asked the question for a reason. So.
Yeah, that's not something you can put into in OM, or Excel doesn't have a model for politics. This is it's a really that's, while the rents might stay the same, collections is a real issue, and there might be opportunity. Obviously everyone's hoping that this gets to the Supreme Court, the case that's ongoing now. Again, if you can stomach the stress and the pain, and yes, emotion is a real factor with these buildings, and you're getting a strong cap rate, and you want to wait for that ray of hope that at some point something is going to change, and these buildings that you're buying for 8 caps are going to be worth 3 caps again, because you have that upside, then one day you'll be a very rich man. But you have to be able to weather the storm.
One of the solutions, incidentally, is if you run your books on an accrual basis as opposed to cash, you're always collecting everything. So.
Yeah.
We always say cash versus accrual is like the best excuse for everything, right? You just throw cash versus accrual at it. No, the other thing that Jason didn't mention is I hate the dynamic of a fixed return with operating expenses that can balloon, right? And a lot has been written, a lot has been spoken about with the real estate taxes in New York City, but there's no leniency given because you have a fully rent stabilized building. They're not sitting there going like, oh, well, we're not going to tax you more. And that dynamic, the dynamic of having cash flow that could actually go down year over year, is a very unappealing and unattractive prospect to me.
So it's more about controlling your destiny.
Yeah. I mean, not that any of us can control our destiny, but to the extent that in business you at least can effectuate a business plan, I think that's very important.
Yeah. But if I called you with a 75% stabilized deal in a good part of Brooklyn that was a 8 cap, you'd print it out probably and take a look. You wouldn't buy it, but you'd take a look.
I'd look at it at an 8 cap, sure.
Oh,
we still haven't really seen those. But
we might be there in another couple of weeks. You never know.
That sounds fine.
Okay. Fair enough. Well, appreciate the comments. I hope this was helpful. If there's any quick question from the audience, particularly on this, I'm happy to address it. If not, we'll sort of shift to the second part of our discussion. Okay, let's shift. So sure. What kind of deals? Where? Okay, so a little too broad a question. We kind of covered after, deferred for after the discussion. Okay, so GPs and LPs, general partners, limited partners. We phrase this, why can't we all just get along? You know, everybody's talking about it, and we're going to talk a little about it here. As you saw from the introduction, sort of our panelists are GPs in certain situations, LPs and others, been sitting on the debt side, and so I think we'll get a lot out of this. So one of the phenomena that I've noticed, and I think many people have noticed, is especially now, everything is fine so long as your distribution checks show up every month, the wire hits quarterly, whatever it is. And as soon as the sponsor misses his first distribution, everybody's up in arms, and it's the sponsor's fault, and you're looking around, and the question is it the sponsor's fault, or is it the investor's fault? I think what we'll find out at the end of today, it's probably a little bit of both, okay? What I've found, and sort of what I'm going to tee this up for our panelists here, is that so many people in so many parts of their life are so meticulous in what they do. When we were talking about prepping for this panel last week, the example that came up actually is a car lease. Most people lease cars. And whether you're a $299 a month person or a $3,000 a month lessee, you shop at the 5 dealerships, 9 leasing brokers to save $25 a month, okay? So you might be paying $50,000, $60,000 over 24 to 36 months, but if you save that $300, you feel like a king, okay? But when it comes to writing a $500,000 check into a deal with a sponsor you never heard of, you don't even read the OM, you don't bother with the operating agreement, and then with these problems, you sort of, you know, it's the GP's fault. So my question for our panelists here is I mean, there's so many things people can do better, but sort of what is the one thing, if you had to pick, you know, one thing that you think an LP can do better with to sort of protect himself and at least make sure that, you know, barring an act of God, if you will, he protects himself from these type of situations where it might truly be the sponsor's fault. Will, if you want to get started.
Yeah, so, you know, we spoke about this on the call, but I think the two key things to me, and I joke that I run a not-for-profit avocation of looking at other people's deals for my investors and commenting on them, is to basically know who you're investing with and understand how much money they're putting into the deal. You just want alignment of incentives, right? It's that simple. And I feel like people look at real estate as if it's just a sexy thing, and they see an address or a building, or their friends are doing it and they want to get involved. And to me, that's a very dangerous game. I think the key is really to know who you're investing with, to get a comfort level with the sponsor. Understanding the real estate is harder to do, but understanding the jockey, so to speak, is paramount.
Jason? Elliot? Choose it out.
Yeah, I want you to go.
Rock, paper, scissors.
Okay, so it's a hard question to answer. I know there's obviously been a lot of discussion about this lately, aligning GP and LP interests, acquisition fees, you know, are GPs deserving of them, how big they should be, so on and so forth. I mean, Will is really hitting, I think, the nail on the head. There's no good answer to it. Acquisition fees happen to be, I mean, I take acquisition fees, but they are industry standard. Do they make sense? I don't really think so. You know, I've heard about, yeah, a guy's got to sweat a lot to raise the equity. He has expenses in his office. I don't think any of those are good rationalizations to actually collecting a acquisition fee, but we do take them. Now, here's the issue. So I was just discussing this with Adam Ermelstein outside. When we started doing deals, you know, I mean, there's been like this drunken party and bonanza over the last few years that has been a huge shift in syndication. When I started doing deals, I was buying $1 million and $2 million deals in Brooklyn. My acquisition fees were $10,000, $20,000, which was a lot of money for me at the time. But you know, I mean, it was $10,000, $20,000, right? And until I did a $10 million deal, I think it was 5, 6 years, and it was with a 1031. I had a lot of cash going into the investment. Since I think 2019, 2020, I mean, you know, when the out-of-state game became very popular, and people were doing 30, 40, 50, 60 million dollar deals and taking acquisition fees of 300, 600, $1 million, whatever it was, right? So in a very, very, very hot bull market, so, you know, that gets much more challenging, to be honest, with your underwriting, with your numbers. You're also not raising $300,000 for a deal. You're raising $10, $15 million for your deal. So I think the most important part, the LPs, there's also been a lot of discussion. Yes, LPs should do their due diligence, this and that. You know, I mean, I don't think that's, should an LP read an operating agreement? Yeah, of course they should. I don't think there's too many people who are saying that they're doing a 70-30 and the operating agreement really says 50-50. I think that would be pretty foolish to do such a thing, even if you are a crook. But the bigger problem is when you're, the integrity of the GP. When you are delivering something to your investors and you're pitching investment to a people and you are taking an acquisition fee for it especially, make sure that they're numbers that you feel that you can perform to and that you'll be able to achieve. Of course, there's shifts in markets, but if you're being too aggressive with your underwriting, if your expenses are too low, lower, either whether it's because you have to be a little bit more aggressive to raise the money, which is dishonest, or maybe just because you're uneducated, make sure that your numbers are right and accurate. And when you're coming to someone and say, I want you to invest with me, you know, you have to make sure that what you're offering them and what you're giving them is something that is truly honest. And, you know, if it's not, so not only is it, are you doing them a disservice, but ultimately, you know, you're going to have your own problems as well. So that, I think, is the most important thing, that from the GP side, just what can the LP do? Yes, like Will said, you got to bet on the jockey. Make sure you're dealing with someone that maybe you know, that you trust, you really checked out. And obviously there could be some bad apples, but the most important thing is that you're dealing with someone who has experience and is trustworthy to deliver what he's telling you he's going to deliver.
Okay, so what can LPs do? You got to read, right? There's a book, a pitch book that comes, and somewhere in that pitch book it says what the promote is. You should read it. But when the operating agreement comes, that's 7,000 pages long, there are two things you have to read, and one everyone focuses on, and one nobody focuses on. And the one thing people focus on are the fees and the promotes. And if you don't understand what it is, you gotta ask questions or don't sign it, right? I've been LP in deals, I've represented LP money, and I told a pretty well-known sponsor, I'm never signing this. There's 5 things here I don't like. I changed all the 5. 4 they agreed on. 1 I checked with my lawyer, didn't have to be changed. We didn't sign it. We came to terms and we signed it, right? So if you don't understand it, understand it. That's number 1. But the second thing people, and we never really spoke about it either, is capital calls. I guarantee none of you understand what a capital call is, don't know what the words mean, don't know the math, don't understand what the ramifications are, and you really have to read these things. You all don't invest. You should not get caught up in, because Joe and Shul's investing, making a fortune, you should invest too. It's not the way it works, right? To that point of the car lease, great point, by the way, it's amazing, right? To the point of the car lease, you would shop around all day to get, so your brother-in-law doesn't tell you spend $50 too much a month, right? So you have to do the same thing with investments. You must read, you must ask questions, and if you don't understand it, either A, understand it, or B, don't invest. Because when things go wrong, because sometimes they do, you will be very surprised at what you signed.
So one of the areas that get a little murky, if you will, is let's just put aside for a second a sponsor who's taken the acquisition fee. Let's say that the acquisition fee, whether you agree with it or not, was in the OM, it was in bold, glowing letters, so nobody could say they didn't see it, and no Monday morning quarterbacking, it wasn't fair, I didn't know. But let's talk about related party type of stuff. So not my brother-in-law making fun of me, I pay too much for the car, but my brother-in-law might be in the cleaning business, the contracting business, doing unit turns for me, he's the insurance broker. How much of, let's call related party, gray area type of stuff do you think should, if at all, be disclosed by the GP to the LPs? What are your thoughts on that?
All of it, right? All of it, right? And there should be a notice in bold. We may have third-party relationships, provided it's at market rate. Now, most LPs don't know what market rate is, right? So I can tell you, we have a situation with a GP who, contracts everything out. We've asked him for full documentation on everything, right? Literally everything. So it's not the end of the world. That brother-in-law may just be the best provider, but he may not be. So The GP owes it to their investors, owes 110% diligence and honesty to the investors to search out the best price. And if it happens to be that his brother-in-law or sister-in-law happens to be the best at whatever, I'm okay with it. But if they're not the best and they're paying too much, you got to get rid of them like tomorrow. That's it.
Anybody have additional thoughts on that?
I think it also dovetails into reporting, right? Because after a deal closes, I've seen this many, many times, you know, for many GPs, that's it. That's the whole thing. Or maybe once a year, they'll send you a 3-line note and be
I
like,
mean, you don't have to call 9 times for your K1 a day before.
Right, or the K1s, that's another good one. Like, so, but I joke, there's only 3 touch points that GPs have with LPs, right? There's the tax return, the K1, there's reporting, like actual documentation of what's going on, and then there's checks, right? Those are the only 3 connecting points that GPs have with LPs. So if you're not sending checks, you sure as heck should be sending K1s and reporting, you know, and obviously optimally everyone's sending checks. So I do think that reporting is pretty important. And one of the questions that as an LP you probably should ask GPs and not be embarrassed is, how do you guys report? Could you show me a sample of reporting for some of the deals that you've done? Because you want to make sure that there is some degree of transparency, that it's not just sort of a situation where they take your money and go behind a curtain and then maybe they give you a check sometimes.
Jason, any additional thoughts?
Maybe just a side point, you mentioned K1. So I think just an important notice, you know, something to talk about for us as a community. And Will knows about this. I had a situation that we sold a property in the end of 2022. We closed on a 1031 on March 16th of 2023. Okay, it was a complicated sale. It was a complicated purchase. The property we sold was bought with a 1031 from a property that had been bought with a 1031 before that. Okay, we're talking about very complicated tax returns. Bring in new partners along the way, so on and so forth. I definitely did not meet the deadline for the K1. We needed extensions, and investors were asking. These are all investors I have good relationships with and trust me. But it took a long time for the accountant to finish the K1. What was going on in the back of my head as this is always going on is, are the investors thinking that there's something going on over here because of all this discussion that's been going on lately? You know, I mean, it was really just, I was following up all the time. I have a very, very good accountant. It was just because of the complication of the returns, it took extra time. So the point I just want to make, I think it's very important for us, if you want to call us the syndication community, that we all, to a certain extent, have a responsibility for each other, right? When certain things are going wrong, or not, everything is not overboard, and you know, people get nervous, they ask questions, then it affects a lot of other people as well. So, you know, I think it's just very important for us. You know, it's good that we have, you know, the Chaim has this Real Deal chat. Everybody knows I talk a lot on it, so you know, I try and give my put in my 2 cents. But you know, it is good that we do have somewhat of a, you know, an ability to network, to discuss these things, because a lot of what we do impacts a lot of other people. You know, we know now it's challenging to raise equity, not just because of the market, but because of other things going on. And you know, we have a responsibility not only to ourselves and our investors, but other people as well. So that's something important to keep in mind.
I appreciate that. You know, sort of, I'll say it differently. You know, the Torah tells us that if someone buys a slave, he's essentially bought himself a master, okay? Because you have obligations. You talk about the Real Deal chat and some other stuff, and I've been speaking to a lot of our clients, GPs, and they do have this attitude, and I'm not accusing anybody, I'm just putting something out there, that, well, like you said, I have my costs, my office, et cetera, and sort of justifying so many things. Now, from where I sit, I've been a GP, I've been an LP, I'm currently a broker for the last 20 years. If you take someone else's money, you've bought a master, you owe him, you're responsible to him, until the day you sell the deal, hopefully to profit, and if unfortunately not, okay, you win some, you lose some, you gotta win more than you lose. What do you guys say to a GP or an LP? Let's turn it the other way. What do you say to an LP who's sort of unknowingly invested in that type of scenario where he's got a GP who's got a little bit of that attitude about the deal, if you will. And things right now are not that rosy. Everything is going the wrong way. What is something that an LP can do to sort of better his position, perhaps massage the situation? Because the follow-up question to this is, we're going to have GPs who say, there's nothing in it for me. Let me just get the heck out of here. So suggestions, if any, for the LPs, or GP, if you will.
Sure. Look, if you're an LP and you're not happy, document everything. Email your GP, call them, whatever you want to do, document it, because you're owed answers, right? And if you don't get the answers you're owed, ask again and ask again. So I can give you a personal situation. I know somebody who's an LP. I guess he's a larger LP, so maybe he's got an advantage, let's call it. And a sponsor, something's going wrong, something's going sideways, and the LP's been after this guy for quite a long time to give him some information, no response. So what he did was he hired a lawyer who now he's responding to, right? So now everyone doesn't have that capability to do it. If you're a $100,000 investor, that money is important. If you're a multi-million-dollar investor, maybe you have a little more of an edge. But if you're not happy, nag the guy. My investors are friends and family for 40 years, 50 years in some cases. I have to respond, and I want to respond because you're supposed to respond. Good or bad, you got to respond. And if you're a GP, you can't just turn away. Like, things go wrong. When things go right, everyone's a genius. They know exactly my distribution's 11% next quarter, right? When things are wrong, we didn't do the calculation yet. We can't figure it out, right? So when you're a GP, you owe 110% diligence, honesty, loyalty to your investors, or use your own money. Don't call people, right? So, but the LP has to be on top of the GP. And what you can do is get a bunch of LPs together, because most people aren't paying attention. They're running their business, their dental practice, whatever they're doing. But if you, collate or collect enough of these LPs.
You mean like a tenants association?
Like a tenants, almost, right? Almost. Say, hey, here's the 10 of us, we're upset. Someone's got to pay. And if they're not paying attention to you, it's really a problem on the GP side.
Okay.
I mean, the most challenging situation I've had as a GP was owning a hotel in Florida during COVID, right? Because it was the first time where I had no control over the outcome, and I was just riding the ride, and I was making decisions with extremely limited information. And at that point, what I did, and I think all GPs should do, is get in front of the issue, right? Don't wait for an investor to call you and say, how's the hotel doing? You know it's doing badly. There's nobody staying in hotels. Like it's a 153-room hotel. When we would get occupancy reports and there were 6 people staying there, I wouldn't be like, why aren't there more? I was like, who are these psychos who are staying in a hotel in March of 2020? So be proactive. I wrote sort of a lot of very soul-searching investor letters during that period, sort of saying the real risk is we could lose everything, right? Because you have to be honest with people. I had no control, and no one was upset. Everyone understood, and thank God we were able to get through it, and the hotel's doing great and sending out plenty of distribution checks. But at the time, it's nerve-wracking. So you have to really, I think as a GP, you have to get proactive, not wait for people to call you. And if you're an LP and you're not getting that sort of communication and that sort of service, to Elliot's point, feel free to nudge. You put your money in, you bought the right to ask. And if people aren't responding, then A, don't do more business with them, which it always shocks me when people seem to go back into bad situations. But really understand the situation, because some situations, there are a lot of them now where the equity, I'm thinking of lots of Upper Manhattan deals, right? The equity is vaporized, but the GP is still charging fees, and they have been, and they will continue to do so until LPs basically realize that they're only in business to pay the GP's fees.
Well, that's a good GP, because very often
They
they
just
have no
leave.
incentive to hang around.
They just leave,
So,
right? Yeah.
fair. Jason, any thoughts?
Just 2 quick points. I mean, just to reiterate what Will said. I think if things are not going as planned, so don't sugarcoat, because things can get worse, and then you really have a problem on your hands. Investments do have challenges. They don't always go as planned, and if things are not working out according to what you had projected, just put it in your report. Make sure you keep up to your reporting. Make sure to let your partners know. Partners, by the way, the investors. Not it's a better term than LP. The second thing is also, I know there's been a lot of discussion about what exactly a GP should do in an environment when they might not see themselves making money in the future because the deals they went into are just not performing. So I just personally, we have a portfolio of rent-stabilized buildings. In 2019, they changed the laws. I would roughly say that the buildings are worth half of what they were in 2019. Now, I don't expect to ever hit a promote at this point on any of those properties. Management of rent-stabilized buildings is a miserable profession. What I can tell you though is that there's a lot of people who gave us a lot of money for these properties, and it's our responsibility to keep pounding the pavement and really grinding to do the best we can to keep them alive as long as possible until hopefully something changes. If you don't have that mindset when you're going into these investments, then you really shouldn't be taking other people's monies. That's the responsibility you have to your investors.
Fair enough. Well, we're out of time, so just going to wrap it up with, first of all, thanking our panelists. I think this was very helpful and insightful. Some closing thoughts that I'll just throw out, sort of taking little tidbits from what everybody said, is number one, within the rent-regulated space in that market, like I said, I think I got Will to admit that he might look at it in a couple of weeks, maybe, you never know. But the real takeaway is that a lot of folks who bought when the market was 4, 5, 6, 7, 8 times the rent, and then said, I'm not getting on this, crazy drunken party train of everything else, they're starting to come back into the market. The point is, we tend to work in circles. Markets are cyclical, obviously, and come back to things. And I think on the GPLP side, that's an important takeaway for candidly all the GPs, let's call them general partners and limited partners in the room, to realize, number one, your partners. But more importantly is, when times are tough, when things are not going your way, it's really your opportunity to build your business and your brand for the future. If you're a general partner and you start playing games, or your phone number is disconnected, or you're not responding, as Elliot said, when things turn, guys who lost money tend to have long memories, guys who, just how it works. So it's your really opportunity to establish yourself. Maybe the deal didn't make money, but I owned it. And if you make a mistake, own it as well. And the same thing with limited partners. You invested with a guy, it didn't work out. You've got to be able to look in the mirror and be honest and say, was it really his fault? Did I maybe not do my due diligence? Maybe the deal was never fundamentally sound. There's no way a 2.25 cap made any sense in the first place, regardless of what the OM said and how great the graphics and the pictures were. And I just invested, as Will said, in the wrong jockey. And if you kind of, learn from these periods in time, it positions you really to take better advantage and maximum advantage of the market in the future. Thank you for coming. Thank you for listening. Enjoy the day.